Are we seeing the first signs of collapse in China's economy? China's 10-year government bond yield dropped below 1.6% on January 3rd. The yuan has weakened to 7.3 against the dollar, and the People's Bank of China may cut interest to deal with deflation. Some people in the West are posting this data on social media and reading negatively into this information. Today, I'm joined by a young professor at Queensland University of Technology and a senior fellow at Taihe Institute in Beijing, Mr. Warwick Powell, to discuss and enlighten us about what these figures actually mean from China's perspective. So let us welcome Mr. Warwick Powell. Warwick, welcome.
Great to be with you. Happy New Year too,
Thank
by
you
the
very
way.
much. Yeah, by the way, Happy New Year. I wanted to ask you your perspective from this information that we're getting from the West. I want to talk about the three things: the 10-year yield, the weak renminbi, the yuan, and the deflation, to try and help our viewers and myself understand how these things are interconnected and how they are presented in ways that are not necessarily representative of a collapsing economy. So, Warwick, if I could ask you to start wherever you feel like it with those three topics, where do you
Sure.
think we should begin?
Well, what I might do is try and paint a bit of a context to help people understand these various financial phenomenon. And the context really goes to appreciating that financial phenomena take place against the backdrop of a real economy. And a real economy a, is a lot more than just the financial dimensions, particularly those dimensions that touch on exchange rates and what I would generally classify as the markets for fictitious capital. So, fictitious capital, in effect, are rights to certain kinds of earnings or future value, and bonds as the fixed income security is a type of fictitious capital. They're called fictitious not because there's something fake about them, but to distinguish these rights to future income or value flows from other forms of capital, such as real capital, machinery, fixed capital, buildings, etc., etc. So it's
Mm.
important to firstly understand that the world of fictitious capital and the world of financial phenomenon take place against the backdrop of a real economy. So that's the first thing I'd say. And what do we know about the Chinese real economy? Well, the Chinese real economy as a whole has continued to expand at almost 5% for 2024, roughly in line with the broad objectives targeted by the Chinese economic authorities at the beginning of last year. This growth rate has meant that China remains on track to achieve its medium-term objective, the 2035 objective of becoming a moderately wealthy society. So, what do we make of these three other indicators? The first thing and I'll touch on, I guess, the bonds market first. That seems to be one that a lot of people get quite worked up about.
It's all over
And
X.
and one of the reasons is that people look at this thing called a bond yield, and the fact that it's falling. And typically, people look at financial indicators that are falling and immediately read into them some kind of a negative attribute, right? You know, falling prices, something is falling, and for a lot of mainstream economic commentary, falling is typically seen to be a bad thing in and of itself and a sign of other bad things. But what's important to bear in mind about this issue of bond yields is that yields actually move in the opposite direction to bond prices. So
Mhm.
why is that? Well, we need to understand what a bond is. A bond is a fixed income security. It is a debt instrument issued by an entity or an organization that is promising to pay a certain fixed amount per year of that bond to whoever holds that bond. In exchange for that bond, people purchase that with money capital, which typically is not an income-bearing security, and exchange that for an income or an interest-bearing security. So a bond typically has, or there's different kinds of bonds. We're talking about government bonds here, particularly bonds issued by the central government as opposed to bonds issued by local governments and bonds issued by corporations. And bonds issued by central governments, in this case, have a number of different types, and they're being issued on a fairly regular basis. And they typically have different maturity times and what we would call a different coupon rate. So the promise is that for the duration of that bond, until it matures, the issuer will pay the holder a fixed amount per bond. So those bonds then become, in theory, tradable instruments. Having purchased the bond from the issuer, a holder can then sell those bonds to others, or others can buy those bonds, should there be a market for them. And the more you pay for the bonds, the lower the return on investment that you get, because the fixed coupon rate is fixed. It's not relative to how much you've paid for them on the secondary market. So the more you pay for a bond, given the fixed rate nature of the coupon, the lower the return on investment, or the lower the yield. Okay, so yields fall as bond prices rise. Bond prices tend to rise when there is demand for them, right? So obviously there are people or organizations that are wanting to purchase those bonds from others in the marketplace. And should there be reasonable levels of interest and demand, then that will tend to cause bond prices to rise as people sell them to others. So that's exactly what's happening in China, in effect. There is demand for the 10-year bonds. So in a sense, so what people say, so the conventional theory would then say people are going to government bonds, which are typically low-yielding securities, right? So the return on investment for a government bond is typically very low, but very safe, right? So government bonds is usually treated as the safest asset class, or a safest fixed income class, certainly. And so people go to those because they have few other options that they find attractive at a given point in time. So that's typically the theory that says an investor is looking for the best return on risk asset class, and if they've got nothing that is exciting to them, or they feel that there are high risks in the economy, then they will purchase bonds instead. On the back of that theory,
what this is basically saying is that there is a high demand of bonds issued by China's central bank, right? So it's not necessarily a negative thing. Okay, sorry, continue.
No, well, so the argument about why it is usually then described as being negative is to say, well, it's because there's nothing else happening in the economy is at high risk, therefore the safest place to go is government bonds. Now, the interesting issue here is, of course, that the Chinese bonds market is quite different to the way that the US Treasuries market operates, for example. Firstly, there's a difference in scale. The Chinese bonds market is still quite a bit smaller than the US Treasuries market in terms of the outstanding bonds. The Chinese bonds market is about 10 trillion US dollars or thereabouts. The US market's about close to 30 trillion. Not quite, but close to 30 trillion. So the US bonds market, the Treasuries market, is considerably larger. That's the first thing. The second thing is that they are regulated in very different ways. So the Chinese bond market is subject to more stringent regulations in terms of the kinds of people that can participate in those markets. And there are stringent controls around capital mobility in and out of the bond market and in and out of the country. So that's the second thing, whereas the market for US Treasuries is far less regulated in that regard. This leads to the fact that the Chinese bond market is also considerably less liquid than the US Treasuries market, meaning that the buying and selling isn't happening at such a greater rate. And this is evidenced
Mhm.
by the fact that the turnover ratio, which is the amount of trades per total bonds outstanding for Chinese bonds, is significantly lower than is the case for US Treasury bonds. What does this tell us? Well, most of the bonds in the Chinese marketplace are actually owned by Chinese financial or regulated wealth management institutions. The second thing related to that is that the Chinese bonds market is relatively illiquid. And what that tells us is that the participants in the Chinese market tend to be buyers and holders. They're not really in the business of
Mm.
trading the bonds. They buy them and hold them through to maturity. And they do that for a few different reasons. Some of them, particularly for the commercial banks, do that because there are regulatory requirements that they hold a certain amount of bonds as part of their portfolio. And they do that also to manage their own liquidity in terms of the cash that they hold. So bear in mind that cash in and of itself is not really an income earning asset, whereas bonds are. So banks will tend to hold a certain amount of their cash, in fact, as bonds instead. They'll purchase bonds and they use that as a way of having an income that is nonetheless a very, very safe and stable income. So that's the way that the Chinese bonds market tends to operate. It fulfills quite a different function than the US Treasuries market. The US Treasuries market tends to play more of a price setting function for all other assets. It doesn't happen that way in China. So
Mm.
to bring, I guess, a mainstream Western theoretical framework to evaluating what's going on in the Chinese bonds market and yields, the movement in yields, is probably the wrong way to think about the Chinese bonds market in the first place. What I would suggest is happening is that principally there is demand for government bonds from commercial banks in China because they are looking for long-term stable income streams, and they see that bonds themselves offer that as a credible and viable option. That's principally what's going on, which is, of course, increasing demand for the bonds and reducing yields. In many regards, there's not that much to see here. So that's the first thing. The second thing is that there are broader moves to continue to reform the capital markets in China, and the bonds market is one part of the broader capital markets regime. Capital markets in China have traditionally played a much smaller role in terms of the national economy than, say, the capital markets have, again, in the United States. Most business lending and growth capital in China actually comes from off-market sources, such as borrowings from commercial banks themselves or private finance, rather than the equities market per se. Right, so the stock exchanges in China don't play that significant a role in the overall allocation of national capital in the Chinese marketplace. There are moves afoot to continue to reform that so that the capital markets begin to play a greater role, not only in terms of the allocation of money capital within the Chinese economy, but to also play a greater role as far as China's long-term retirement strategy is concerned, meaning retirement
Mm.
incomes. So what we're starting to see, particularly over the last few years, are reforms to the pension system and reforms to the financial products regulatory system, enabling the creation of more fixed income products that are better from a yield point of view than government bonds, but which nonetheless are a strong and stable fixed income security for the Chinese wealth management and the Chinese retirement/pension schemes funds to participate in. So there are
Mm.
ongoing changes in how the capital markets are expected to contribute both to economic development, but also to the long-term payment of retirement incomes to Chinese retirees as people get older. So that's the bonds market in context. Yeah.
The interesting thing there is to point out what you just said, just to summarize for people. The bonds market in China is very different. Three aspects: its size, how regulated it is, and the lesser liquidity that it has. So this is why it's incorrect to actually look at it from a Western lens and try to analyze it from a Western lens, being that it performs and it behaves in different ways. The other thing that I wanted to touch on is, why is it that China needs to issue bonds? Normally, what uh, regular people think is, oh, these are just how America finances its thing. So America issues treasury bonds, and then that's how they finance their operations. What is it that China do? Why do they need to issue these bonds? And perhaps that connects in a way to, um, how do how does deflation affect, sorry, not deflation, but
Sure.
the weaker the weaker yuan, with respect to the US dollar, affect the amount of US dollars that China retains? Why does it issue bonds? And is there any connection to a weaker renminbi?
Look, there's obviously quite a lot of debate about exactly what it is that bonds do. Why do governments issue bonds? The conventional theory is that governments issue bonds to fund their operations.
Hmm.
The problem with that theory is that it actually doesn't ask the more fundamental question, which is, where do the dollars come from in the first place? Right. So if you issue bonds in exchange for dollars, the dollars have to come from somewhere first. And the dollars can come from really two places. Okay. New dollars, that is, or new money. New money is either fiat money, which is money issued by central government and central banking authorities working in coordination with each other. So this is the central bank together with the government treasury. That's one way in which new money comes into the economic system. The second way in which new money comes into the economic system is when commercial banks create credit. Okay, so that's what we call fiduciary money, right? So fiduciary money and fiat money are not entirely identical with one another, because the money from government is slightly better and slightly more secure than the money from commercial banks. But for most practical intents and purposes, they are interchangeable. So that's where new money actually comes into the system. Governments don't actually issue bonds to get money for themselves. Okay, the money is created first, because otherwise people don't actually have the money to buy the bonds in the first place. So what's the effect of bonds? That's probably the more interesting question. So
Hmm.
when an institution or an individual has dollars, they obviously are confronted with a range of choices about what to do with those dollars, particularly those dollars that they don't need to satisfy their purchasing requirements on a day-to-day basis. So those unused dollars, those dollars that are typically out of the processes of day-to-day circulation, are then held in a number of forms. They can be held as money capital, meaning as deposits in depository institutions, and they may earn a modest interest on that. If you hold that money capital as cash in a box under your bed, you earn nothing, right, from that, right? But if you are looking to earn more money on your money, you need to convert that into a different kind of security. And you convert that into a portfolio of securities that are riskier or not as risky, that are more liquid or not liquid at all. And depending on one's risk appetite and one's needs for liquidity, one will choose a different portfolio mix, so to speak. One of the assets that holders of money capital will tend to invest in are bonds. Bonds are fixed income securities issued either by governments or by corporations typically, and the investment in those provides the holder with a fixed income. The markets for these bonds, particularly in the Western context, have traditionally also been very liquid, so that a US government treasury, a treasury bond, is as good as having cash. Okay. Right. So
Mm.
it is as good as having money because it is just as liquid. If you wanted to sell that bond, you can sell it. No problems at all. There are willing buyers, at any minute of the day for people who want to sell those bonds. So, so the bonds themselves are ways in which a price can be established for what is in effect a risk-free asset. And that
Mm.
price that's established as a risk-free asset becomes the benchmark against which all other assets can be priced. Okay, so the Chinese Treasury, the national government, in terms of issuing bonds, is really doing that to manage the amount of money capital within an economy. It also does it because there are regulatory requirements for commercial banks to hold a certain amount of their assets as bonds, as fixed
Mm.
income securities issued by government. In other words, as safe as the government itself. So that's why bonds are issued. The Chinese government is really engaging in a series of fiscal operations through the issuance of bonds by which it can create new money in the marketplace. Okay,
Mm.
but also at the same time, take money out of the economic system, meaning money capital, in exchange for the bond instrument. So that's what's going on with the government bonds markets, right? It's different for local government bonds because local governments can't create their own currency. So local
Okay.
governments
Mhm.
issuing bonds are actually exchanging those bonds for existing monies. Okay.
There's
So
no creation.
they're not creating new money in that process. They because they can't. They don't have the legal authority to create new money. Right. So
Mm.
they are actually in effect raising money. In very simple terms, they're not currency issuers, they are currency users.
Mm.
So that's what's going on. The question around the exchange rate, I think, is probably one that's better understood in the context of the broader operations of Chinese monetary policy. And China has, for a long time, operated what is essentially a managed peg or a managed float, depending on which way you want to look at it. And it has, for a long time, hovered around that 7 RMB thereabouts for a
Mhm.
US dollar. And it manages that by coming in and out of the market for US dollars and RMB. By buying and selling these currencies on the foreign exchange markets, they are able to modulate the overall exchange rate. Again, the real issue is what are the effects of a relative movement in exchange rates. Now, bear in mind that uh, as the RMB softens, that's a relative idea. It's softening against something else. So we're talking about
Mhm.
it softening against the USD. So instead of needing 7.1 RMB to buy one US dollar, you now need 7.3. The issue, of course, is on the flip side of it, you've got a strengthening US dollar. So a supposedly weakening RMB is also the effect of a strengthening US dollar. And the question is why why are institutional foreign exchange traders buying more US dollars at the moment than they are something else? And that goes to the way in which US monetary policy works and in a sense, the relative attractiveness of the earnings that you get from holding US dollar assets, such as US treasuries, etc. So these things are related to each other. So it's much more about the way capital flows work than it is about anything else. The
Mhm.
the effect of that, obviously, is how much of one national currency you need to buy um, something that is denominated in another national currency. So this
Mhm.
affects the relative value of your investment activities, for example. You now
Mhm.
need more RMB, slightly more RMB today than you did a month ago, to buy the same thing as you could a month ago for a little bit less RMB. On the flip side of it, you have a situation where you need less US dollars today, slightly, than a month ago to buy the same thing. Okay, and
Hmm.
the impact that has on things like cross-border trade is that countries with a relatively stronger valuation will tend to be able to import more than
Hmm.
countries with a relatively lesser relative valuation. So a higher valued US dollar vis-a-vis the RMB will tend to contribute to increased US imports from China and
Hmm.
decreased Chinese imports from the United States. So
I
what can we expect from that? Well, the irony is that the stronger the US dollar, the greater the imports the US will have from China.
make America great again. It's not working with a strong US dollar then. um, I wanted
Well,
to
that's
touch on,
precisely the point, Fernando.
yeah.
Is that the objective of, say, for instance, a trade policy that seeks to establish trade balance um, between the US and China can't happen with a strong US dollar, relative strong
Yeah.
US dollar. It's not possible. So you can't, on the one hand, say, I want a strong US dollar, whilst on the other hand, say, but I want reduced imports from China.
Mm. Well, what they're trying to do, from my perspective, is they're trying to increase exports of things that don't have too much added value. So sanctions on tech, sanctions on this, sanctions on that. So it goes back to low profit margin items, which China is not interested in producing anymore. They're moving that to other places around Southeast Asia to manufacture. So what is the MAGA move from now on with regards to China's sanctions is yet to be seen. I wanted to also address the other topic that's been around Twitter and news with this turn of the new year, which has to do with the deflation.
Sure.
Beijing had a speech uh, issuing something about talking about why is it bad that things cost less today? Why is it bad to have deflation? And you mentioned something, I think, on X, in which you said that deflation in China has a different, like a different flavor, or a different. You need to look at deflation in China differently than you would look at it in other countries. Why don't you tell us a little bit about what
Sure.
is the effect of deflation in China, and why is it different in China than in other countries? Why should we look at it differently?
Well, we need to understand that there are many different kinds of deflations, if you will. And in fact, there's been some very good work done in the academic literature that looks at the historic dimensions of episodes of real price decreases. So, deflation, we're talking about real price decreases, right? And
Hmm.
periods of inflation is when you have real price increases. And again, there's a difference between the historical record and what I would call a relatively caricatured or cartoonish theory about deflation. And that cartoonish theory about deflation, which is a little bit of a trope, but it's a very misleading and simplistic idea, is that deflation only has one dimension, and it is a function of a collapse in aggregate demand, which causes enterprises to discount heavily to clear inventory. Okay.
Hmm.
In that context, when there's a collapse in aggregate demand and a heavy discounting on the supply side to clear inventory, we have deflation related to a contraction of the economic system as a whole. Okay.
Hmm.
That particular configuration has arguably only happened once in a couple of hundred years of history, and it was the period immediately around the 1929 1930s Great Depression. We have had other episodes of real price decreases, but they haven't been a result of a collapse in aggregate demand. Rather, they've been a consequence of a combination of rising demand with even faster rising supply in highly competitive markets. And that's what we're seeing in large part in China. Okay. Now, the property sector, I'll come back to in a moment, because the property sector has also seen real price drops, and that has been a consequence of a reduction in demand. But let's talk about the economy as a whole first. So a year ago, the trope around Chinese deflation was already floated, that somehow this was representative of a collapse in demand, and therefore China had a collapse in consumer confidence, people weren't spending money, etc., etc. The problem with that theory is actually threefold. Firstly, Chinese households continue to grow their expenditure, as do enterprises, by the way. So aggregate demand in both investment demand and consumption demand terms has been growing at almost 4% per annum. That's the first thing. The second part about this story of a collapse in aggregate demand, which doesn't ring true, and deflation, is that in fact Chinese inflation has been slightly positive, close to 1% per annum in real terms. So we actually haven't had, in aggregate terms, a comprehensive deflationary environment anyway. So that's the second point. The third point is the idea that you've got a collapse in output. So that's usually the caricature argument, which is a collapse in aggregate demand leads to a collapse in prices, which then leads to a collapse in output. Chinese economic output continues to rise as well. And we see that in all sorts of areas, but particularly in the areas where there has been significant investment growth over the last 3 to 4 years, and that is in your high technology and your electronics areas. And EVs is a great case in point. So EVs has intensive price competition in the Chinese marketplace, but EV production continues to grow. So there are more EVs produced today than there were this time last year, and more EVs are consumed in China than were consumed this time last year as well. So we have an environment where there is downward pressure on pricing due to intense competition, whilst demand and supply both rise. This is the kind of quasi-deflationary environment that we have in China, generally speaking. Another great example of this actually is in a much more mundane area, which affects the bigger inflation picture, and that goes to the price of pork. So about 2.5 years ago, as China was coming towards the end of the epidemic period, there was significant talk, particularly in the Western media, about a major contraction in and a deflation of Chinese pork prices, right? And that was meant to be a crisis. But of course, within 12 months, the Western media reported a different crisis in the Chinese pork environment, right? Which is an excessive supply problem leading to price drops. And what happened in that intervening period was that coming out of the COVID years, there was expectations of a dramatic increase in demand for pork, and there was an increase in demand for pork, to which pork producers, or pig farmers more particularly, pig producers, rapidly ramped up production. So they began to have their sows can breed again to create more pigs. Now, the supply side went at this with gusto. And what happened over the course of the next 6 to 12 months was, yes, demand did increase, but supply grew so fast that it was way too much for the market, and therefore the prices dropped. Right? So the Western media suddenly began to get, to talk about deflation in the Chinese pork market as a sign of a collapse in consumer confidence. But of course, that is actually not what happened at all. Chinese households continued to eat more pork, their demand for pork continued to rise, but the exuberance of the supply side led to an overshooting of pigs in the market, which then put downward pressure on pork prices. So that's what's going on. Now, the housing market is actually quite a different story, because we know that the price of housing over the course of the last 4 years, 4.5 years, has been dropping. And it has been dropping in all of the major cities from tier 1 through to tiers 2 and 3. So what has happened? Well, again, we've got to look at the experience over the course of, say, the last decade and a half. And what we saw, firstly, was the global financial crisis hit the world in 2008 or thereabouts. That led to significant liquidity problems in the global economy. Bank-to-bank settlements became problematic. Central banks around the world actually coordinated to boost global liquidity, and Chinese banks and policymakers at a fiscal level came to the party and injected a significant amount of new money into, firstly, the Chinese economic system, and through its imports of goods from other parts of the world, injected that liquidity into the global system. Much of that increased liquidity that was created led into the fast tracking of urbanization. So during the course of the 2000s, China had already been on an urbanization process. More and more people coming in from the countryside, moving into the bigger cities. Well, from 2010, 2011 onwards, this process of urbanization kicked up another notch. And much of that was fueled by the additional liquidity that was injected into the economic system on the tail end of the global financial crisis. Credit for property also grew, or for property development activities also grew substantially. So we saw from, say, 2014 through to around 2018 or thereabouts, a rapid growth in the rate of growth of credit into property development, from around 5% per annum to over 20% per annum. So this is how fast credit was being created in the property sector. And unsurprisingly, the price of property grew commensurately. So much so that come 2019, 2020 or so, the real price of an average dwelling had almost tripled as a proportion of income compared to the price it was 6 years earlier. So China already has a relatively high property price to average income ratio, and that increased to almost 3 times what it was back in 2014. Now, this resulted in a few things. One was, at a social impact level, rising concerns that a lot of people were beginning to be priced out. Problem number one. At the same time, there were considerable concerns, which were already evident by 2017, 2018, of excessive leverage, meaning that the rate of credit growth had exceeded the capacity of the sector to actually repay those loans when those loans came due. And in 2017, everyone knows the story now. The government, through Xi Jinping, made it very clear, sent a signal to the market that houses are for living in, not for speculation, number one. One of the directors of the People's Bank of China also observed at the time that there were concerns at a financial stability level that that China faced the risk of its own Minsky moment. So a Minsky moment is named after Hyman Minsky, an American economist who developed what he called the financial instability hypothesis, which is that in stable conditions, as finance seeks greater returns in competitive environments, it progressively takes greater and greater risks to a point where it begins to make loans on projects that can only be paid for in the event of other loans being made for other things. In other words, we reach a Ponzi stage of finance.
Yeah.
So, and that generates the risk of a crisis whereby the borrowers are no longer in a position, because they lack the liquidity to service the
To
loans,
repay.
and the house of cards begins to fall. That, by the way, is in summary what happened in 2008 in the United States, and then feeding over into some of the other Western economies. But there were concerns in China that this was what China faced because of the rapid growth of credit in property development. So this message was sent that this was not going to be sustained. Now, in that period, 2018, 2019, and then into 2020, quite a lot of property developers actually heeded those messages from government and regulators and began to sell down their portfolios and
Mhm.
reduce the amount of leverage. And in fact, a large proportion of property developers with portfolios in China and overseas did just that and successfully deleverage. Some property developers didn't, and of course, they're the ones that we hear a lot about, the Evergrandes
Mm.
and things like that. So, come 2020, there were still some concerns that there was significant leverage, but by then, with the introduction of the three red lines policies, credit growth was pulled right back. So, by 2021, the annual rate of growth in credit to the property development sector had come back down to a bit less than 3%. So it was at about 22, 23% back in
Gee.
2018, and it got contracted. Now, the price of property is directly correlated with the rate of growth of credit. So when credit
Mhm.
growth is squeezed, the price will also come down, okay, because you're taking demand out of the system. So, and
Mm.
this is exactly what's happened. So demand has been stripped out of the system through policy initiatives to deleverage and to reduce credit growth. And so we have a very particular form of deflationary effect in the property sector caused by government actions to deleverage what was viewed as a high risk situation. And the high risk went to the risk of a financial crisis occasioned by the inability of the property sector to service its loans. Now, the rate of growth of credit in real estate has now come back to 4.5%, 5% from memory. So we're starting to see credit growth come back into this sector. And
Mhm.
unsurprisingly, we're starting to also see the bottoming out of the price falls
Mhm.
and what looks like the beginnings of a stabilization of price levels. What's interesting about this, and this will be my last point on the property stuff, is that the price to income, average price to average income ratio today is back to what it was at about 2014. And
Interesting.
as high as it is in globally comparative terms, it's more than two times. For instance, Beijing, average income, average price, the ratio is about twice that of New York. So, so Beijing, for instance, is an expensive city in global terms for
Mm.
a comparative square meter of an apartment. But it is back to where it was at in about 2014. And we've
Wow.
gone a full circle now. And incidentally, that whole circle has happened whilst at the same time maintaining an economy through COVID as well that
Yeah.
has sustained employment levels whereby unemployment hovers around 5%, that real wages have been increasing. Real wages have been growing at, close to 4%, 4.5%, sometimes 5%. So real wages are growing, employment levels are stable, whilst one of the key sectors of the economy, historically, the real estate sector, has been deliberately contracted as a proportion of the economy as a whole. And the compensation for that, of course, has been the dramatic growth in these other areas that we now see, such as high-tech manufacturing, electric vehicles, robotics, etc.
It's what our good friend Jerry Gray calls a soft landing. That has been a masterful. I see reports talking about how historic this has been from Beijing to be able to handle this potential crisis and turn it around to a level of normalcy without letting it affect other aspects of the economy. Um, masterfully done. Warwick, I wanted to finish our talk with a very short question regarding what are we to read into these kind of reports about data that is put out there on social media by people in the know, people who know what you know as well, but they deliberately portray it as something negative. How can we combat that kind of negative read into things that could actually have a positive read?
Look, people will believe what they want to believe. So there is always, I think, for many people out there, there is a sense of confirmation bias.
Mm.
I think one of the useful things for people to be able to do is to try to reduce the extent to which they want positive or want negative. So that's, whether it's a positive or a negative form of hope, or wish, and appreciate how complex systems simply change and evolve, and think about them in terms of a dynamic process of evolution. So,
Mm.
what are we trying to understand about the Chinese economy? Well, we're not necessarily trying to say it's going to collapse tomorrow or it's going to boom tomorrow. What we're trying to do is understand how a very complex system continues to change in ways that deliver upon the aspirations that different people have for the lives they want to lead, whether it's the life of somebody living in an urban environment in China for cleaner air and more parks and those sorts of things, or to be
Mm.
able to access, better healthcare services, or to enable their kids to be able to go to a good school and receive a good education. That's the way I think to think about the evolution of complex systems, rather than treat them as football games, right?
Mm.
There is no end game.
Yeah.
Social and economic systems are perpetually in motion. They are continually evolving, and and a useful way to think about them is not so much that somehow there's a final whistle gets blown at some point, but simply how they evolve and what are the drivers and institutions that shape their evolution. Right, so we go back to the bonds market. The
Mm.
institutional setups for the bonds market for the US Treasuries versus Chinese central government bonds is very, very different. Now, you don't actually have to have a wishful view about one or the other. The first thing to do is to understand why those differences exist, and
Mhm.
importantly, what are the implications of those differences. Now, you then can reach normative judgments about the situation if you so wish. So, for example, if we looked at the American political economy, it's easy to see that it is an economic system with a heavy weight towards the world of finance and insurance and real estate. There is a very large marketplace for fictitious capital. The bonds markets, the stock markets, the derivatives markets, the FX markets are huge in the context of the American economy. It is where the vast majority of new monies created in the American economic system ends up. The American economic system, in GDP terms, sees about 16% committed to health services. That's well, about 18%. That's almost twice as much as the global average, right? That's just a description of the structure of how the system works. And
Mhm.
then you can make some judgments about it, and you might then say, well, it seems unbalanced if you want an economic system where health costs are more affordable for people. But if you
Mhm.
don't, and you believe that the private health insurance industry should be able to do what it does, then you will take a different view. Okay, right. So you can bring a normative lens once you've actually sorted out your descriptive lens, and that's the way I tend to approach what the Chinese economy is like today, what it has been historically. You got to remember, I began my own academic journey and then subsequently into work in government and then in business, undertaking research on Chinese political economy. And so now for 40 years, I've watched and analysed how this system continues to evolve. And you've got to work quite hard on yourself to not be too invested in, from an analyst's point of view, to firstly not be too invested in the good news or the bad news, whether a goal was scored or someone made a good tackle or someone was
Mhm.
offside or whatever it is, right? The first thing to do is just to understand the dynamics of the system and what it is that the system itself is seeking to achieve on its own terms. You've got to remember that China has set itself a series of objectives. As I mentioned at the outset, one of its medium term objectives, economically and socially, is to be a moderately prosperous society by 2035. And on the basis of its own definition of that objective, it needs to achieve compounded annual growth of about 5% to achieve its objective. That's what it's trying to do. That's what it's trying to do. Not trying to be anything else, not trying to meet some other person's judgment as to what it should or shouldn't do. They are the goals that China has set itself. And that's the
Yeah.
first thing to evaluate progress against.
Warwick, I know that you're a very busy person. I really thank you for joining me today in this video to try to explain to people a little bit what all these things that we're seeing in the media actually mean. And I love how you put it in the end that it's not a game, it's not a win or lose. It's just how things develop and how societies develop. And living here in China for most of my life, I can actually see the effects of those directives that Beijing has taken. Life keeps improving. Um, Social benefits keep improving. So whatever they're doing in Beijing seems to be working. Warwick, once again, thank you so very much. And well, I hope to have you once again in my videos to try to explain to people how to understand information that seems to be a little bit too complicated for people to grasp. So thank you so very much. And well, if you would like to say goodbye to our audience one more last time.
Look, thank you very much for having me, Fernando. It's been an absolute pleasure, and it's good to kick off the new year with, I hope, some content that will help people think about what's going on in the world.
Indeed, indeed. Well, that's it for today, guys. Until we see you again, take it easy and bye for now.